That's relatively easy. I did it myself with the Dale Carnegie course. Some people wish I'd taken a shorter course now in terms of my talking later on. But it's just hugely important. And if you invest in yourself, nobody can take it away from you. I mean, and you can't start taking care of it when you're 50. By that time, you'll have rusted out if you haven't done anything. So
I have watched financial markets for a very long time, not every day, not with excitement, but with patience. Over the years, I have seen prices rise far beyond reason and fall far beyond expectation. I have seen people make life-changing gains by doing very little, and I have seen people destroy years of progress by doing too much. Right now, many people are focused on one question: silver. Should I sell now and take my profit, or should I wait and hope it goes higher? On the surface, this looks like a simple price question, but it is not. This question reveals something much deeper about how people make financial decisions under pressure. Silver was trading at very low levels just a few years ago. Today, it is much higher. For those who bought early, this is not a small win. This is meaningful money. And whenever money becomes meaningful, emotions quietly take control. Greed enters the conversation, fear follows close behind, and clarity often leaves the room. Before talking about silver specifically, there is one principle that matters more than price, more than predictions, and more than expert opinions. You must understand why you own something, not the story you tell others. The honest reason. If you bought silver because you believed it could protect purchasing power, because you understood long-term industrial demand, or because you wanted a small hedge against uncertainty, then price movement alone should not force panic. But if you bought silver because it was rising, because people were talking about it, or because you feared missing out, then honesty is required. That was not investing, that was speculation. There's nothing shameful about admitting that. Most people learn this lesson at some point. The problem is not speculation itself. The problem is pretending speculation is investing. Investing begins with purpose. Speculation begins with hope, and hope is not a strategy. History is full of examples where hope felt justified, until it was not. There was a time when silver reached extraordinary prices before. At that time, people were confident it would keep rising. Many believed it could not fall. They had reasons. They had charts. They had experts. And yet it fell. Not slowly, quickly. Those who bought near the top did not fail because they were foolish. They failed because they forgot something important. Markets do not move to reward conviction. They move to test it. This is why understanding what you own matters more than believing in where it might go. Silver is a commodity. That matters. A commodity does not produce income. It does not innovate. It does not grow on its own. An ounce of silver today will still be 1 ounce decades from now. Its value will depend entirely on what someone else is willing to pay for it later. This does not make silver useless, but it does define how it should be treated. Commodities can play a role, but they are tools, not engines. An engine creates forward movement. A tool serves a specific purpose. Confusing the two leads to disappointment. Businesses, on the other hand, are different. A productive business generates cash, it reinvests, it adapts. Over long periods of time, well-run businesses can compound value quietly. That compounding is slow, boring, unexciting, but it is powerful. This difference explains why holding a commodity requires more discipline than holding a business, because with a commodity, nothing happens while you wait. Only price moves. That makes patience emotionally difficult. Another critical question often ignored is concentration. How much of your total financial life depends on this one idea? If silver represents a small portion of your overall picture, its movement should not disturb your peace. But when one asset grows too large, it begins to control emotions. And emotional control is dangerous. People who concentrate too heavily often tell themselves they are confident. In reality, they are exposed. Diversification is not about maximizing returns, it is about surviving mistakes. Even the most thoughtful investor will be wrong sometimes. Diversification accepts this reality and plans around it. History is unforgiving to those who ignore this lesson. Entire decades have been lost by people who believe too strongly in a single idea. Another quiet but important question is time. Do you need this money soon? This question changes everything. If money will be needed in the near future for real responsibilities, education, health, or reducing stress, then volatility is not your friend. Markets do not care about personal timelines. They move when they move. People who are forced to sell rarely sell at good prices. The greatest advantage any investor has is the ability to wait. And waiting is only possible when money is not urgently required. This is why financial security is not just about returns, it is about flexibility. Flexibility allows patience, patience allows rational decisions. Without flexibility, even good investments become dangerous. Now let us talk about psychology, because psychology matters more than data. When prices rise, people feel intelligent. When prices rise quickly, people feel validated. Confidence grows, caution fades. This is the moment when mistakes usually happen, not because information disappears, but because emotion grows louder. Markets have a habit of testing people at their most confident moments. This is not cruelty, it is human nature. When something works, people believe it will continue to work. They increase exposure. They delay risk management. They tell themselves this time is different. Sometimes it is. Often it is not. One approach many disciplined investors use is reducing risk without abandoning the position. They rebalance, they take partial profits, they move gains into productive assets. This is not dramatic, it does not create excitement, but it protects progress. The purpose of investing is not to be right on every move. It is to remain solvent, patient, and emotionally stable long enough for time to work. If someone does not own silver today and is considering buying only because it is popular, that deserves caution. The worst reason to buy anything is fear of missing out. By the time something feels obvious, much of the opportunity has already been priced in. History shows this clearly. The best opportunities rarely arrive with applause. They arrive quietly. They feel boring, uncomfortable, unpopular. This is why patience is so valuable. Patience allows you to act when others are distracted. Discipline allows you to avoid acting when others are emotional. Long-term wealth rarely comes from bold predictions. It comes from boring consistency. No one knows where silver will be next year or next month. Predictions create false confidence. Clarity removes regret. Clarity comes from knowing why you own something, how much you own, how long you can hold it, what role it plays. When these questions are answered honestly, decisions become easier. Every financial decision moves you closer to peace or closer to anxiety. There is no neutral choice. The goal is not excitement. The goal is stability. Stability allows sleep. Sleep allows health. Health allows enjoyment. Money is a tool, a useful one, but only when it serves a thoughtful life. This video is not telling you to buy silver, sell silver, or predict silver. It is asking you to slow down, to step back from price screens, to look at your full picture, to replace hope with structure, because structure survives emotion. Financial security is not built through speed. It is built through clarity, planning, and calm decisions made consistently over time. This video is for educational purposes only. It is not professional financial advice. If this way of thinking helps you feel calmer about financial decisions, you are welcome to stay with this channel, not for predictions, but for perspective. Because real wealth is not built on one trade. It is built on years of patient, disciplined, and thoughtful decisions that quietly compound into something meaningful. I want to continue from where we left off, because once people understand why they own something, the next challenge quietly appears. What do you do when an investment actually works? This sounds like a good problem, but it is often where the most damage happens. When prices rise and profits become visible, clarity is tested, not by fear alone, but by temptation. I have seen many people handle losses better than they handle gains. Losses make people cautious, gains make people confident, and confidence, when unchecked, can become carelessness. When an asset like silver moves sharply higher, the conversation usually splits into two voices. One voice says, "Take the money, don't be greedy." The other voice says, "Hold on, this is just the beginning." Both voices sound reasonable, and that is what makes the decision difficult. The mistake is believing there is only one correct answer. In reality, the right decision depends on context, your context, not the market's excitement, not headlines, not predictions, your life. This is why experienced investors do not ask, "Where will the price go?" They ask different questions. How does this fit into my life now? How much risk am I carrying? What happens if I am wrong? These questions are quieter, but they are more useful. One of the most overlooked truths in investing is that time changes everything. An investment that made sense at 40 may be inappropriate at 55, not because it is bad, but because your needs change, responsibilities change, energy changes, flexibility changes. Many people fail to adjust because they anchor themselves to old decisions. They say, "This worked before, so it must keep working." But markets do not reward loyalty. They reward alignment. Alignment between risk and reality. As people move closer to retirement, the role of money shifts. In earlier years, money is about growth. Later, money becomes about protection. This transition is difficult emotionally. Growth feels exciting, protection feels boring, but boring is often safe, and safety becomes more valuable when there is less time to recover from mistakes. One of the biggest errors I have observed is people increasing risk when time is running out. They feel pressure. They realize they did not save enough, or inflation feels heavier, or retirement suddenly feels close, so they take bigger bets. This usually ends badly. Risk is not something you add when time is limited. It is something you reduce. This does not mean eliminating all risk. It means controlling it. A common balanced approach some people take is gradual de-risking, not selling everything, not panicking, but slowly adjusting, reducing exposure, rebalancing gains, strengthening the foundation. This approach lacks drama. It does not feel heroic, but it works. The purpose of money is not to maximize excitement. It is to minimize regret. Another quiet danger during profitable periods is lifestyle expansion. When people see account balances rise, they often increase spending without noticing. A better car, a bigger home, higher fixed expenses. These decisions feel justified, but they quietly lock people into higher income dependence. Income, unfortunately, is not guaranteed forever. Markets change, health changes, energy changes. A life built on flexibility is more resilient than a life built on assumptions. This is why simplicity matters. Not extreme simplicity, intentional simplicity, knowing what truly improves your life and what merely impresses others. Impressing others is expensive. Peace is cheaper. Another important idea many people resist is the concept of doing nothing. Doing nothing feels lazy, irresponsible. But in investing, doing nothing can be a decision, a thoughtful one. When you own quality assets with a clear purpose and a balanced allocation, constant action is unnecessary. Most harm comes from interference. People try to improve good plans and end up breaking them. The urge to act often comes from discomfort with uncertainty, discomfort with boredom. But boredom is often a sign that things are working as intended. This is why long-term success rarely feels exciting. It feels quiet, predictable, stable. That stability creates space for life, for relationships, for health, for peace of mind. Another reality worth acknowledging is inflation. Inflation is not dramatic, it does not announce itself loudly, it erodes slowly, it punishes inaction and poor planning. This is why holding all wealth in cash is risky over long periods. But chasing every inflation hedge is equally dangerous. Balance is required. Inflation protection should be part of a plan, not the plan itself. No single asset solves every problem. This is why mature investors think in systems, not in bets. A system spreads risk. A bet concentrates it. Systems survive uncertainty. Bets depend on being right, and no one is right consistently. Another issue many people face as they age is decision fatigue. After decades of working, raising families, and handling responsibilities, mental energy declines. Complex strategies become harder to manage. This is not weakness, it is reality. Simpler structures are easier to maintain, and maintenance matters. A plan that looks perfect on paper but is too complex to follow will eventually fail. Simplicity increases compliance. Compliance increases success. This is why some of the most successful people end up with very simple financial lives, not because they lack options, but because they value peace. They remove unnecessary decisions. They automate what can be automated. They reduce noise. Noise is costly. It leads to impulsive decisions. Late-night worry, second-guessing. Clarity removes noise. Clarity comes from structure. Structure comes from honest reflection. At this stage of life, the most important question is not, how much more can I make? It is, how much risk do I actually need to take? Often the answer is less than people think, especially once basic needs are covered. Enough is a powerful word. Knowing what is enough creates freedom. Freedom from comparison. Freedom from pressure. Freedom from endless chasing. Chasing never ends. Preparation does. As this part comes to a close, there is one final idea to hold on to. Money is not meant to create stress. It is meant to reduce it. If your financial decisions increase anxiety, something is misaligned. Alignment may require slowing down, reevaluating, adjusting, not dramatically, gradually. Financial maturity is not about bold moves. It is about thoughtful restraint. It is about understanding that protecting what you have built is a form of success, especially when the future matters more than the next headline. This video is for educational purposes only. It is not professional financial advice. If this way of thinking helps you feel calmer about money and the future, you are welcome to stay with this channel. Not for predictions, but for perspective. Because real financial security is not built through speed. It is built through clarity, planning, and calm decisions made consistently over time. As life moves forward, something quietly changes inside us. The questions become softer, but deeper. Earlier in life, most questions are about progress. How far can I go? How much can I build? How fast can I move? Later, the questions change. How long will this last? How fragile is my position? What happens if something unexpected occurs? This shift is natural. It is not weakness. It is awareness. Retirement for many people is misunderstood. It is not an event. It is not a finish line. It is a long phase of life that requires stability, flexibility, and emotional balance. The biggest mistake people make is preparing financially, but not mentally. They focus on numbers, savings, accounts, returns. But they do not prepare for how money will feel once income slows down. When regular paychecks stop, money feels different. Every expense feels heavier. Every market movement feels louder. This is why peace matters more than performance in the later years of life. A portfolio that allows sleep is more valuable than one that promises excitement. At this stage, capital protection becomes a priority, not because growth no longer matters, but because recovery time is limited. A mistake at 30 can be fixed with time. A mistake at 60 can change everything. This does not mean eliminating all risk. It means respecting risk. Understanding that money now has a job. Its job is not to impress. Its job is to support life, support health, support dignity, support independence. Independence is the real goal, not luxury, not status. Independence. The ability to make choices without panic, the ability to say no without fear, the ability to slow down without regret. Another realization that often appears later in life is the importance of simplicity. Complex financial structures become harder to manage with age, not because people become incapable, but because energy becomes valuable. Mental energy, emotional energy. A simple plan that is easy to understand and easy to maintain often outperforms a complex plan that creates stress. Stress is expensive. It affects health, relationships, decision-making. And poor decisions are far more costly than modest returns. This is also the stage where legacy enters the conversation. But legacy is often misunderstood. Legacy is not the amount of money left behind. It is the example that is lived. Children and family members learn more from behavior than from inheritance. They learn from how money was handled, how stress was managed, how patience was practiced. A calm approach to money teaches confidence. An anxious approach teaches fear. Many people believe they will feel peace once they reach a certain number, but peace is not a destination. It is a discipline. It comes from alignment. Alignment between spending and values, between risk and reality, between expectations and resources. People who delay peace often never fully experience it. They keep telling themselves just a little more, just one more year, just one more push. But time moves quietly, and the best years are not meant to be spent in constant financial tension. Another important truth is that comparison becomes more dangerous with age. In earlier years, comparison can motivate. Later, it usually creates dissatisfaction. Someone will always have more. Someone will always appear better prepared. But preparation is personal. Your life is not their life. Your needs are not their needs. Clarity comes from understanding what is enough for you, enough income, enough security, enough comfort. Once enough is defined, many pressures disappear. Spending becomes intentional, risk becomes controlled, decisions become calmer. This clarity also changes how people experience retirement. Those who enter retirement with structure feel freedom. Those who enter without structure feel anxiety. Structure does not mean restriction. It means predictability. Predictability creates confidence. Confidence allows enjoyment. Enjoyment is often missing when people focus only on accumulation. This stage of life is not about accumulation. It is about preservation and purpose, preserving health, preserving relationships, preserving peace. Purpose does not disappear with work. It changes form. Time becomes more flexible. Energy becomes more selective. Money should support this transition, not complicate it. As this series comes to an end, the message is simple. True financial success is not loud. It does not chase headlines. It does not rely on predictions. It prepares. It balances growth with protection. It values peace over pride. It respects time. Money is a tool, a useful one, but it is only valuable when it supports a well-lived life. Financial security is not built through speed. It is built through clarity, planning, and calm decisions made consistently over time. This video is for educational purposes only. It is not professional financial advice. If these conversations help you think more clearly about money in the future, you are welcome to stay with this channel. not for excitement, but for steadiness, because finishing well is the quietest and most meaningful form of wealth. As we come to the end of this conversation, take a moment to pause, not to react, not to predict, just to reflect. Markets will always move, prices will always change, noise will never stop. But clarity can be chosen. Money is not meant to create constant tension. It is meant to support a steady life. The goal was never to guess the next price. The goal was to make decisions you can live with peacefully. True financial security does not come from one perfect move. It comes from thoughtful planning, controlled risk, and calm discipline over time. This video is for educational purposes only. It is not professional financial advice. If these discussions help you think more clearly about money in the future, you are welcome to stay with this channel, not for excitement, but for steadiness. Because real wealth is not built in moments of emotion, it is built quietly through clarity, patience, and decisions your future self will be grateful for.